In every business, we need to measure performance of managers, performance of departments. So in this video, I'm going to talk about two of the most important performance measurement tools, which are known as return on investment and residual income. Hi, if you're new to my channel, I'm the commerce specialist. I create content covering learning outcomes of various academic qualifications and professional certifications, including life-changing business ideas and hacks. So in today's video, I'm going to discuss ROI and RI, which is return on investment and residual income. Guys, if you're not yet subscribed to my channel, please subscribe. It helps me a long way. And don't forget to press the bell notification button so that you get my videos on a timely basis. So let's talk about return on investment. Return on investment is a performance measurement tool. Using return on investment, we can measure performance of a department or a division and also performance of a manager. So first, let's talk about the formula for return on investment. So ROI is actually calculated as net profit divided by investment multiplied by 100. So there are various versions of this in different books. Sometimes you will have at net profit divided by total investment. Sometimes you can have net profit divided by capital employed into 100, obviously, or sometimes it is net profit divided by average investment, or sometime it is net profit divided by average capital employed. So all the formulas are okay. So let's discuss what is the significance of ROI. So I'm assuming we have two departments, let's say department A and department B. The respective sales, I'm just assuming 10,000 here, 10,000 here. Okay. Cost of sales or cost of goods sold is 2,000. As a result, you get a gross profit of 8,000. And expenses, I'm assuming the only expense they have is salaries, okay? And 1,000 is the salary of one employee. Each department has 3 employees. So salary is 3,000 here, 3,000 here. Okay, so how much is the net profit? 5,000. And as per the formula, ROI is equal to net profit, which is 5,000. And I'm assuming the investment is 20,000. Remember this amount? So I'm just assuming that investment is this into 100. Likewise for department B, 5,000 divided by 20,000 into 100. So both the department has an ROI of 25%. So what does it tell us? It tells us that in department A, you invested $20,000 and it gave you a return of 5,000. In terms of percentage, 25. Same in department B as well. Had department B's ROI been, let's say, 30%, so we would have considered that department B's performance is better than department A, or this manager is better than department A, because though the investment is the same, okay, if the net profit was different, it would have given us 30%. So in a nutshell, higher the ROI means higher the performance. But here you need to understand that if you are the manager who is doing the performance appraisal, you got to be very, very fair. Why I'm saying you got to be fair? Because you have to look at controllable performance. So in some books, you will see the formula of ROI like this. Instead of net profit, they will say controllable profit divided by controllable investment. Or sometime instead of controllable profit and controllable investment, they write traceable profit divided by traceable investment. So what is meaning of controllable profit and controllable investment? If you're measuring the performance of two departments or two managers, you got to be very, very objective. You got to be very, very fair. because ROI is a performance measure which can be manipulated. So how it's manipulated? Let me show you. Let's assume manager A, his boss, the general manager, told him that you don't need 3 employees. Instead, you need 6 employees in your department. So in that case, what is happening? The top management is interfering into his department and forcing him to hire not 3 but 6 employees. As a result, this will become 6,000. And 8 minus 6, his profit will be 2,000. So when we calculate ROI, the profit is 2,000, the investment is 20,000. If you do it into 100, you will get 10%. And now when you compare it with department B, what is the ROI of department B? 25%. What is the ROI of department A? 10%. As we know, higher ROI is always better, which means in the annual performance appraisal, department B's manager would be considered as a better performer, a better performing department as compared to A. But the inside story is department A's manager was not allowed, was not given the freedom to take decisions on his own. In fact, the top management interfered in his affairs, made him hire more workers which were not required. You know, you have references, okay? So sometimes your bosses force you to do something for their own interest. So there is a possibility he wanted 3 employees. 3 additional employees were relatives of his boss, and he was told to accommodate them, though he didn't want it. So he was forced to accommodate 3 more employees. As a result, his salary expense became 6,000 from 3,000, and his profit went down to 2,000 instead of 5,000. And there was no interference in department B's affairs. Yeah, so the profit is 5,000 and ROI is 25, whereas in department A, the profit is 2,000 now and the ROI is 10. So in the annual performance appraisal, only department B's manager is commended, given some benefits, bonuses, and department A manager is not. What has happened? Department A manager did not get the required autonomy, the freedom to take decisions. So if you are the senior manager, you have to go deep and see, was this expense controllable by this department manager? The answer is no. This 3,000 was controllable. Having 3 more employees was not in his control because the top management forced him to hire. So here, what is the lesson to learn? Whatever gets measured gets manipulated. So if you are a senior manager measuring performance, you have to eliminate uncontrollable factors so that you look at the real performance. Real performance was actually both was getting 25-25. But because uncontrollability factors are there, as a result his performance went down, so is the ROI. So you have to keep this in mind. Here I want to give you one example of once in an organization, my boss called me and he said, look, you need a generator in your department. I told my boss, I don't need a generator in my department, but he was insisting to buy a generator for my department and from a specific supplier. So I had to listen to my boss. I purchased a generator. Now let's assume this was the scenario, the old scenario. Okay, scenario is 3 employees here, 3 employees here, and so now let's look at this. Scenario was earlier 25% ROI here, 25% ROI here. Let's say I am here now. This is me. If everything was okay, There was no interference, no pressure from the top management. Everything was in my control. I had the freedom. What is my ROI? 25. What is Department A's ROI? 25. Now that my boss forced me to buy a generator, which I never wanted, he forced me to buy a generator for his own personal reasons, personal benefits. What happened to my performance? Profit is the same. The new generator was for 20,000. So 20,000 was my old assets, total assets. Now it has become 40,000. Okay. So if you do it in 100%, how much it comes to? It comes to 12.5%. So as a result of interference from top management, what is happening to the denominator? Total investment was 20,000, total assets were 20, now it is 40 because I've purchased a generator. As a result, my ROI was earlier 25 and now it has become 12.5. So if you compare my performance, my ROI with the other department, I am not a good performer. Apparently, I'm not a good performer. But the real reason is that there were certain elements beyond my control. Pressure from the top management. So if you happen to be a manager later on, if you're comparing two managers or two departments, make sure you only focus on controllable items, not uncontrollable. Because if you measure performance of your managers on uncontrollable item, that does not reflect their true performance. Actually, it is your performance because you're forcing them to do things they don't want to do. Okay. Likewise, I used the word traceable. Traceable profit divided by traceable investment into 100. Now, what is traceable? This happens when you're talking about measuring performance of two departments in a big organization where there is head office and branches. So when we say traceable, we are talking about traceable investment or traceable assets. Assets which belongs to the department. Profit, which is departmental profit. Sometimes what happens, the head office distribute some overheads which belongs to head office, they distribute those overheads to the departments. Now these overheads are not the department's own overheads. Overheads means expenses. So if you load here in these expenses, if you add some overheads which belongs to the head office, so this will obviously go up. When expenses, your overheads will go up, profit will go down. When profit will go down, ROI will go down. So here again, if you're measuring performance, you have to keep in mind that are we talking about expenses specific to that department, or among the expenses there are overheads which belongs to head office which shouldn't be here. So I hope you understood what I'm trying to tell you. ROI, yes, it's a performance measurement tool, but it can be easily manipulated. How? If something happens to the net profits, look here. I told you how net profit can be manipulated. If there is pressure from the top management, your expenses may go up. If it goes up, profit will go down. So if the net profit is manipulated somehow, it will affect the ROI. If the denominator investment is manipulated, remember in my example, my boss made me buy assets which I never required. So if that happens, your denominator will increase. If your denominator will increase, your ROI will go down. Even in examination, keep an eye on how ROI is calculated. Make sure you're taking the net profit which relates to the department and which is controllable. Make sure you take the investment or total assets, whatever it is, controllable. It should be controllable. Now, for your understanding, sometimes in some questions it says average investment. That is okay. Average investment means investment at the beginning of the year plus investment at the end of the year, add them, divide by 2. If the formula says, in some books, it says net profit divided by capital employed. So let me tell you, capital employed, how it is calculated is total assets minus current liabilities. So you will have capital employed here. That formula is also correct. Sometimes it says the ROI is calculated based on average capital employed. So you calculate capital employed at the beginning of the year plus capital employed at the end of the year, divide by 2. That would be your denominator. So you can have total assets, total investment, total capital employed, average investment, average assets, anything in your denominator depending on the question given. Having discussed ROI, now let's talk about residual income. So the formula for residual income is like this. Residual income is equal to net profit minus, let's say, average investment into cost of capital. So I'm just assuming some numbers. Let's say net profit is 25,000. Your average investment is 100,000 and cost of capital happens to be 10%. So all this information will be given to you in the question. So 25,000 is the net profit. 10% of this is 10,000. So 25 minus 10 will give you 15,000, and this is your residual income. As I told you, residual income is used as a tool for measuring performance. So apparently, a positive residual income is considered good. Higher, the better. But here you need to understand what is the concept of residual income. So I can explain this from two different angles for you, whichever you understand. Let's assume this investment you're talking about, you invested it in the business or in the department, right? This investment, had you not invested in your business, this money, average investment, had you not invested in your business, this would have been deposited in the bank. Had it been deposited in the bank, you would have earned some interest from there. How much? 10%. Because you invested it in the business, you are not getting that interest. So that is your opportunity cost. So although you made a profit of 25,000, but you also lost 10,000 as opportunity cost. You invested the money in the business. You could have invested the same money in the bank and got 10% interest, which you're not getting now. So yes, you have made 25,000 profit in your business, but what about the 10,000 which you have lost, which is your interest income? So if you account for that, what is the residual income? 15,000. Another way of looking at residual income is how much profit you have made? 25,000. Assume that the investment in the business, 100,000 you invested in the business, that's how you made a profit of 25,000, right? This 100,000 was borrowed from bank. It was a loan. So let's say you took a loan 100,000 from the bank and you had to pay 10% interest. So how much interest you have to pay? 10,000. How much you have made from the business? 25,000. So 25,000 is your net profit, but the loan which you took bears interest. So after subtracting the cost of funds, how much you're left with? What you're left with is your residual income. Higher the better. There has been a debate. Now, which tool is better, ROI or RI? So let me give you an example where you'll understand which one is better. If you look at ROI, it's a percentage, 25%. So let me give you an example. There are two partnership companies, Mr. A and B, and there is one company for me, which is C and D. So two partnership, A and B, and C and D is mine. I am C and there is D, my partner. So we are inviting you to become our partner. You decide to join partnership A and B, you have to invest 100,000. Obviously, you becoming a partner, you have to invest 100,000. And A and B, they are telling you, if you invest 100,000 with them, you will get 50% share in the profits of the business. 50% share. Invest 100,000 with them, you get 50% share. Our offer is, if you invest in our partnership, yes, you invest 100,000, but we will give you 10% share in the profits. So which company, which partnership you would like to join as a new partner? You invest there. So if you join them, investment 100,000. If you join us, investment required 100,000. But if you invest with them, you will get 50% share in the profit. And if you join us, you will get only 10% share in the profit. So which one you will join? Can I hear? A and B? Obviously, they're giving you 50% share. Okay, so you join them for 50% share. You invested 100,000. At the end of the year, they made a profit of $10. You invested 100,000. At the end of the year, they made a profit of $10. 50% of that is how much? $5. You will get $5. And you know what? My partnership made a profit of 200,000. We promise you that you will get a 10% share in profit. Profit is how much? 200,000. 10% of that is 20,000. So think, had you invested 100,000 with us, you would have got a share of profit of, though it is 10%, but the amount comes to 20,000. But you were a bit greedy, you invested with them, looking at that you'll get 50% share in the profit, but you need to see how much the profit is. The profit is just $10. So you're investing 100,000 and getting only $5. Had you invested with us 100,000, you would have got $20,000. The moral of the story is, percentages are misleading. They said 50%. 50% seems big, but 50% of what? That was $10. We said 10%. 10% looks small, but 10% of what? 200,000. So that's why we say ROI, because it's a percentage, it's kind of misleading. But when you look at residual income, it's an amount. An amount cannot be misleading. Yes, if you have residual income of two different businesses or two departments, whichever gets higher residual income is better. Negative residual income is not recommended. Okay? So it has to be positive, and higher the better. So that's why we say there are many advantages and disadvantages of ROI and RI, but the main is that residual income is better than ROI because it's an amount. Okay? And amounts cannot be misleading. Percentages can be. If you have any question relating to ROI and RI, feel free to leave a comment. I will reply to you as usual. If you're not yet subscribed, please subscribe my channel. That's one way to show that you value my work. If you like this video, please share it with your dear and near ones so that others can also benefit. Thank you so very much for your precious time. Love you all.